What if one small action today could raise your credit score enough to knock tens of thousands of dollars off a future mortgage, and most people never even consider it? 10 hacks, some old school and some brand new for 2026 that actually move scores right now, not in some hypothetical future, not maybe, but in practice for people dealing with modern scoring models. Stay with me, because one of these is a surgical trick that lenders now accept on mortgages since 2025, and it's shockingly underused. Scores updated in 2024 through 2026 changed the game. FICO's newer families and VantageScore 4 now look at trended payment behavior and alternative data in ways older models didn't. That means established levers still matter, but a few newer tactics can deliver real, measurable lifts, sometimes within a single reporting cycle. This narration will walk through the top 10 credit score hacks that actually work right now, explain exactly why they work under modern rules, and show quick timing and numbers so you can act fast. This is educational only, not legal, tax, or financial advice. Rules and models change. Verify with your lender or a licensed professional before major moves. First and always, payment history is still the biggest single factor. So bringing any past due accounts current and removing provably incorrect late marks is the highest impact move. Pull your free reports at annualcreditreport.com and look for wrong balances, duplicate collections, or identity errors. Dispute anything provable. Bureaus generally investigate in about 30 days. In many cases, a successful dispute can remove a damaging late payment or duplicate collection and produce a double-digit score jump at the next update. If a debt is valid, negotiate a pay-for-delete only in writing. Many collectors won't do it, but some will. Many bureaus removed small medical collections across 2024 and 2025, reducing their impact in 2026. Want a quick win? Fix what's wrong first. It's the fastest path. Revolving utilization is the fastest lever to move a score. The headline targets are familiar. Under 30% is standard. Under 10% often gives optimal improvement. But with trended data in modern models, how you carry balances over time matters more. If you pay down your card before the statement closing date, the lower balance is what gets reported and used in the next score calculation. Make multiple payments per month or set a payment right before the statement cut to cut reported utilization dramatically. Models that track trends reward consistently low balances more than one-time payoffs followed by rebounds. So a strategy of small, regular payments that keep utilization under 10% across cycles can produce steady score gains rather than volatile single-month jumps. Authorized user additions and secured or credit builder loans still work, and they're often the best option for thin file consumers. Getting added as an authorized user to a seasoned, low utilization primary account can instantly add a long, positive trade line. But with trended models, the primary account's history of stable low balances matters. Being added to a card that spikes to 80% utilization sometimes helps less. Credit builder loans and secured cards that report to all three bureaus create on-time payment history. For example, a $500 credit builder loan with monthly on-time payments for 12 months builds a steady record that modern scoring models value because it shows sustained behavior. Alternative data reporting rent, utilities, telecom, and some bank-based payment boosts gain traction in 2024 through 2026. VantageScore 4's wider adoption in mortgage underwriting and lenders' greater acceptance means adding rent or utility payments can meaningfully help thin or non-traditional files. Services that report rent or utility payments to bureaus can add months of positive history. Not all lenders or scoring variants weight alternative data equally. Always confirm whether the lender will consider that bureau's file. And beware the flip side. If a service reports missed rent or missed utility payments, those negatives can now show up where they didn't before. Still, for many renters, reporting positive rent is a reliable boost. Buy now, pay later reporting expanded in 2024 and 2025, and by late 2025, some models began incorporating BNPL trades. Good news, on-time BNPL payments can help build payment history if the provider reports. Bad news, missed. BNPL payments can now hurt because they're being added to credit files more than before. So don't treat BNPL as free credit, treat it like a trade line. If you have no other installment history, a single reported BNPL plan with consistent on-time payments can add enough positive trend to move a thin file several points, sometimes meaningfully improving loan terms. But if you miss payments, the downside is immediate. Ask each BNPL provider if they report, and whether they report to all three bureaus, then decide. Trended data is the real game changer in modern scoring. Instead of snapshots, models look at balanced trajectories. That means consistent behavior, steady low balances, and monthly on-time payments is rewarded more than one-off fixes. So what should you do differently? Don't just pay off a huge balance once and then let utilization climb. Instead, create a pattern. Keep balances low month after month, or pay multiple times per cycle to flatten the trend. For people aiming for a mortgage, lenders began using these modern models widely as of the 1st of January 2026. Timing your pattern of low balances in the 3 to 6 months before an application matters more than ever. Hard inquiries still matter, but modern models create shopping windows, cluster multiple rate-seeking pulls for mortgage or auto within a short window to count as a single inquiry. Most models allow 14 to 45-day windows for rate shopping. FICO variants often give a 45-day window for older versions and shorter for newer variants. So here's how to time it. Do all your rate shopping within the model's window, then pause new credit applications for at least 45 days after the final pull to avoid extra hits. This is especially important now that lenders may use different model versions. Confirm the window with your lender if you can. If you're doing a mortgage, lenders have adopted modern scoring in many cases since early 2026, meaning that precisely timed pulls can reduce inquiry impact even more than before. Medical collections were a huge score killer for many people. Across 2024 and 2025, bureaus and regulators rolled out changes removing many small and paid medical collections. As of 2026, paid medical collections often don't appear, and thresholds for reporting small balances were adjusted. Order reports, identify any lingering medical collections, and follow dispute or verification processes. If a collection is paid, confirm the bureau removed it. If not, escalate with documentation. Policy varies across bureaus and states. Don't assume automatic removal, verify and push for corrections where necessary. Credit mix and age of accounts still matter. Opening a stapled low-limit card just to diversify can help, but it can also shorten average age if not timed. A better play for many consumers is to add a credit builder loan for installment history while keeping existing revolving accounts stable. Authorized user additions can also add age if the primary account is seasoned. Remember, with trended scoring, the story of long, steady performance outweighs a handful of new accounts that spike and drop. If a mortgage or auto loan is coming, sequence moves. First, fix errors and cure delinquencies. Next, stabilize utilization by paying down cards before the statement dates for at least the 2 most recent cycles. Add any rent or utility reporting at least 3 months before applying if possible, so trended models see the positive pattern. Do all rate shopping within a single window and avoid new credit applications in the month before underwriters pull scores. For example, if closing on a mortgage in 3 months, start paying down utilization now, confirm any rent reporting is active, and do all lender shopping in a 14 to 45-day block, depending on your lender's model. Always ask lenders which score and version they'll use. Adoption varies across lenders and products, and the exact uplift from a given tactic depends on that detail. Quick recap: cure delinquencies and dispute errors first. Manage statement period utilization, target under 30%, ideally under 10%. Use authorized user and credit builder products to add positive trade lines. Report rent and utilities and use Boost products carefully. Treat BNPL as credit on time helps. Missed payments hurt. Build consistent trended behavior, cluster hard inquiries, and verify medical collection removals.